Welcome to Capitalize Your Finances, the podcast that's your ultimate guide to mastering personal finances and unlocking the secrets of entrepreneurship. Each week, we dive into the world of personal finance and business development and have fascinating conversations with industry experts, seasoned entrepreneurs, and thought leaders who share their insights, strategies, and stories to help you get ahead in life. Whether you're a seasoned entrepreneur looking to scale your business or someone just starting out on your financial path, this podcast is your go-to resource for inspiration and actionable insights.
Welcome back to Capitalize Your Finances. As always, I'm your host, Chris Ray Poniotu, certified financial planning professional, the Cap in Capitalize. And on today's episode, we are going to talk about investing within your 401k. But before we do so, as always, the free advice for the week. When it comes to money, focus only on what you can control. Now we've got that fun little tidbit out of the way. We are going to get into this, and we've got a lot to go over because there are, frankly, a lot of things that people just simply don't understand when it comes to the 401ks or 403bs or 457s of the world. And that is a shame because more often than not, your 401k is going to be your ticket to financial freedom. So let's start with why your 401ks matter. Now, there's two ways to contribute, generally speaking, to a retirement plan, because most retirement plans allow you to contribute either pre-tax or Roth. Now, pre-tax is known as a traditional contribution to your retirement plan. And the reason why it's called traditional is back in the day, not to get a little nerdy here, but the ERISA Act of 1976, I believe it's 76, it came out and basically introduced the 401k to the world. Nope, I take that back, 1972. It's beside the point. ERISA Act introduced 401ks to the world. And it wasn't until the 2000s, I believe it was 2001 or 2002, where you could go and invest Roth, which is after tax. And there is pros and cons for each of them. And there's tax strategy. We're getting into that later on in this show. But regardless of where you decide to go with this, the power of compounding long-term with your retirement plans, it is so underappreciated in this world. And unfortunately, a lot of people don't realize it until it's too late. And they look at their friends that have been doing it for 10, 20, 30, 40 years if you're into retirement. And as far as, what you should, try to earn, we'll talk about this later on. But frankly, for the majority of you listening in, if you haven't started your retirement contributions, just start, and the rest of it will take care of itself as far as investments, eventual success rate, and all that. Now, how do you choose your investments within your retirement plan? Because you got to understand there's, generally speaking, a lot of options, and it can get complex. Now, there are investment options that are defaults, and they're generally called QDIA, so qualified default investment options. And the most common options, there's two of them. There are target date funds, and then there's custom portfolios. So you might see something called an aggressive portfolio, a moderate portfolio, conservative portfolio. And then you've got the target date funds where, let's say you're going to retire in 2060. Well, you would select the 2060 target date fund. Now, a lot of people ask me which ones are better. And I'm going to rustle some feathers here. Target date funds are absolute garbage. And I can prove to you why they are garbage. So I remember, and there's a couple ways to think about this. Back in 2014, there was a financial researcher in our industry named Rob Arnott. And what he did is he went back from, I think it was from 1892 through 2014. And he said, okay, what if there was just one huge target date fund? And then what if you took another portfolio and flipped the idea of a target date fund on its head. Now, I should probably preface what that even means. So generally what target date funds do is they invest in stocks, which are considered more aggressive, in bonds, which are considered more conservative. And over time, when you first start out, the majority of your portfolio is in stock. A small amount is in bonds. Over time, it starts to trade out of stocks, more into bonds. So by the time you get to retirement, the majority of your money is theoretically in this very conservative portfolio. And then you ride off into the sunset with this just magical sum of money. Well, what Rob did is he said, why don't I flip this idea on its head? And going from 1892 to 2014, that takes timing out of the picture because that's well over 100 years. And then you just understand the strategy of these products. So here's what he found, and this is pretty interesting. By going the exact opposite in terms of what a traditional target date fund will do for you, you would have approximately 22% more by the time you retire, as opposed to sticking to a traditional target date fund. So to say that another way, if you went against the grain of conventional wisdom within our industry, you would actually have a 22% pay raise in retirement. Now, I'm going to explain further why these are absolute garbage. So generally speaking, what do we know the market has earned in the long run? Okay, this is not a guarantee for compliance people that have a knife to my throat. Generally speaking, the market is going to earn, on average, let's call it 8 to 10%. Okay, 10% if it's in a really good period, 8% maybe it's a little bit lackluster. So let's just be conservative and say 8. There's plenty of facts and figures out there. Okay, maybe a little bit more, a little bit less. Let's go with 8. What do bonds historically earn? Well, a bond is generally, because a bond is a lot more conservative than a stock. Bonds generally earn around the 3 to 4% mark, depending on if it's through the government, through a company, net of taxes. There's a lot of facts and figures. So let's just call it 3 to 4%. So let's just think about this for a second. Let's say that you're listening into this show and you're 30 and you're not going to retire till you're 60. So you've got literally another lifetime to go until you retire. So you're telling me over 30 years that you're going to take money out of the market, which is probably going to earn around 8%. And then you're going to choose to earn 3 to 4% because it's considered more conservative. So by doing so, you're sacrificing arguably a 50% increase in total return, if you think about it. That is beyond insane to me. Now, a lot of these target date funds, I'm getting a little technical here, but it's worth noting this. Target date funds in my industry as a whole have gotten away with utilizing target date funds because we're recording this in 2025. Basically, since 1982, when Volcker decided to just jack up interest rates. I think prime was 20.5%. I remember my mom was saying she was ecstatic to buy her house with a 17.5% mortgage interest rate, which is crazy. Well, basically since 1982 through today, really through 2022, interest rates just came down and they kept coming down and coming down and coming down. And when interest rates drop, bond prices increase. So you got lucky over the last 40 years of taking money out of the market in buying more bonds because bonds were earning almost stock-like returns. Well, guess what? The next 40 years, probably you're going to be way out of luck with that. So there's no more room to get away and get lucky with that. So if you're asking, where should I go with this? You're probably going to want to look into those custom portfolios, or you go and invest yourself within these retirement accounts, because you can go in and select your own investments. Now, if you don't go and do that, that's why there is that qualified default investment option. And again, a target date fund is better than anything, but you have to go in and select something, or else you don't even know what you're investing in. And I'm not asking you to become the next great investor of our time, but you need to have a bare bones understanding of what's going on. Even if you work with a financial planner and you're like, yeah, my guy or gal just goes and tells me what to do and I do it. Ask the basics. Why am I doing this? Educate yourself. Elevate yourself. Like, this show is not trying to bring on people like Dave Ramsey's show. Dave has a bunch of people that comes on, they call, he basically just verbally crucifies them for doing things that they shouldn't be. And somehow that's his brand. You've got people like Susie Orman out there where they're just giving blanket advice, or Robert Kiyosaki. This show is not for that. You're listening to this show, you are elevating your status in that. You are becoming much more sophisticated than the strategies that they are looking into, and you want to be active with your situation. So make sure you level up with that. Now, when it comes to what should you do and how specifically should you invest within your 401k, you're not going to like this answer. I don't know, because I don't know your situation, but we've talked a lot about, within the confinements of my framework, how you need to invest based on where you are at circumstantially in your retirement timeline. And really, it's that simple. And if you have a different flavor of investing, maybe you prefer investing in smaller businesses as opposed to larger businesses or things of that nature, that's all secondary. The point is, you need to understand where you're at within your financial situation. You need to stick to the framework, and you need to commit to it, and you need to be actively aware. Don't shut your brain off. Now, when it comes to evaluating, or in some cases reevaluating, your risk tolerance and diversification within your retirement plan, I've talked about risk tolerance in the past. Y'all know how I feel about it, that I've listened in for many, many years now. But for those of you that are new, the new capitalizers to the show, first off, welcome. Second off, not a huge fan of risk tolerance, because you're investing on emotional unintelligence with money. Again, we are not trying to put you into the world of conventional financial influencers out there like the Ramseys or the Oarsmen or the Kiyosakis or any of that. You are coming in and you are leveling up from that. Don't succumb to the emotional unintelligence with money. And that is all risk tolerance is. Now, I'm not saying risk tolerance is not important. That should not be the first thing when it comes to investing or planning. If anything, from a behavioral finance perspective, that should be maybe the last thing that you talk about. But that's all I have to say on the risk tolerance. Diversification. Again, I'm not against diversification. And with a retirement plan, generally speaking, these retirement plans are invested in funds, mutual funds. Well, what is a mutual fund? A mutual fund is an investment that owns hundreds, if not sometimes thousands, of different companies, or if it's a bond mutual fund, different bonds or CDs, money markets, etc. So what I'm saying is the diversification is already there. So if you selected just a couple investments within your retirement plan, on paper, you may only have 2 or 3, but if you open up all of those funds, you could have thousands of companies, or just investments in general, invested within your retirement plan. So again, I'm not against diversification. I think it's completely overblown. I personally think over diversification is for those that don't know what the hell they're doing. And again, you know better, because you're listening to this show. So understand what you're investing in, select what is appropriate for you based on the framework, and go to town with it. Now, when do you review your investments? Now, I'm a believer in, systematically looking at it on an ongoing basis, whether that's weekly or whatever the case is. But that doesn't mean just staring at it and becoming unhealthily emotionally attached. What I'm talking about is you want to understand the investments, the businesses, or the mutual fund managers that are managing that money. And frankly, once you understand that and you have your framework and your allocation that makes sense for you, you're probably not going to change your investments for a very long time. With the massive exception to if your company decides to swap out investment A for investment B, that's where you're going to want to go back into your retirement plan and look at your investments and go, okay, does this investment still make sense? I know this is instead of, investment A, investment B, but it's still trying to do the same thing. Does it still make sense for me? Is there something in that investment that I should look into? And if it doesn't actually fit, how does that change my allocation? That's really the big one that you need to look at. But generally speaking, your allocation is not going to change for a very, very long time. Now, before we get into the commercial break, one more thing about these mutual funds. Mutual funds are ran by asset managers, investors, and they invest on your behalf. So if you've got a fund that has, let's say, 13 different investment managers all looking at that fund, generally speaking, that fund isn't going to change a whole heck of a lot, even if one person leaves or whatever the case may be. But I have seen in the past, let's say you have an investment within your portfolio and there's one manager on that fund, and then that person leaves and a new person comes in, you're going to want to check to make sure that that new person has the same mentality that the original person had on the fund, because if not, even though the fund on the surface may look the same, it's a completely different fund. So with that being said, we're going to take a quick commercial break. And then when we come back, we're going to talk about maxing out contributions and then some common pitfalls to avoid. And then we're going to close this thing off and you're going to ride off into the sunset. So don't go anywhere. Stick around.
Are you ready to transform the way you approach sales? This episode is sponsored by the second book in the Capitalize series, Capitalize Your Sales, the all-in-one sales framework that saves you from ever struggling again and teaches you how to sell with sincerity, which dives deep into the art and science of driving sustainable growth. Packed with strategies that go beyond surface-level techniques, this book will help you understand what it takes to truly connect with clients, build long-term relationships, and close deals. Whether you're looking to fine-tune your sales craft or break through to the next level, Capitalize Your Sales offers a roadmap to success designed for today's fast-paced business world. Head on over to your favorite bookstore, order today, and start capitalizing your sales immediately. And now, back to the episode.
Welcome back from the break. I cannot wait to get back into maximizing contributions within your 401k. So again, we're kind of taking a step away from investing for a second and just talking about just the magic with your retirement plan. The thing that you're going to have to focus on is prioritizing the employer match. And for those of you that are not aware of what that means, that is basically free money if we want to translate it. So if you have a company retirement plan and that company says, I'm just going to make this up, we match a dollar for dollar up to 4% or 50 cents on the dollar up to 5%. It doesn't really matter if it's dollar for dollar, 75 cents or 50 cents, whatever. The point is whatever that percentage is that they match up to, you want to make sure you're contributing at least up to that percentage. Why? Because it's free money. And everyone loves free money. Okay? Everyone. So not only is it free money, translating it, by doing that, that is going to help compound and get you to retirement that much faster. All things being equal. Now, let's talk about the benefits of maxing out your retirement. And some of that is obvious, right? Because the more money you put in, obviously the more money you have to accumulate and compound and get that much closer to retirement that much faster. But you got to know the limits here, because you can't just like put in millions of dollars to your retirement plan, although that would be kind of cool. So as of 2025, if you are under 50, the maximum you can put in is $23,500. If you are over 50, you can put in $30,500. And then there's a weird caveat for this year between 60 and 63. You could put in $34,750. It's a weird rule. Congress put it in. I don't know why. They don't answer my calls. So I am just the messenger here. But the point is, you want to make sure that you max out your retirement plan before you look to go anywhere else, meaning an individual retirement account, a non-retirement account, just like an investment account. And the reason for that, we already talked about the match because you want to get at least up to that. Two, the fees are generally speaking going to be a lot lower in the retirement plan versus going to an individual retirement account. And then the last one, it's simplistic. It's kind of nice having one account versus 4 or 5 or 10 just all over the place. Less is more in the world of money when it comes to number of accounts. Keep it simple. No one's going to ask you if you got to $1 million based on a complex strategy or a basic strategy. The fact is, you're going to have $1 million. So why don't you make it really easy on yourself? Now, as far as the common pitfalls to avoid with a retirement plan, so one of the things that it's thrown out a lot in this industry, and I'm not saying I disagree with it totally, ignoring plan fees or expense ratios. So what do I mean by that? First off, retirement plans are not free, and your employer will, generally speaking, pay a lot of that, but there are going to be some very small expenses that you're going to have to pay along the way, whether it's just having the money at wherever it's at, which is called the custodian. Think of it as like the savings account, but for your retirement plan. If you take a hardship or a loan from your retirement plan, a company called a third-party administrator has to process all that. And generally there's a fee for that. But I'm not trying to get into the weeds of all that. There are costs there. But then when you look at the investments within your retirement plan, generally speaking with these mutual funds, there are expense ratios. Now, I know a lot of these expenses have come down over the years because index funds have become massively popular. And in particular, the company Vanguard has done a wonderful marketing job of bringing those costs to basically nothing. However, that's not always the right thing to do. Just because something costs absolutely nothing does not mean that's the right answer, because you do often get what you paid for. Shocker. So I say this because I've seen people where they look at their retirement plan and they go, whoa, like fund ABC, his expense ratio is 1%. And then fund, I don't know, CDE or whatever, fund number 2, the expense ratio is 0.5%. So I'm going to invest in that one. Well, you're kind of missing the whole point here, because if that fund is trying to earn you 3 to 4%, the 0.5, but then the 1% is trying to earn you 8, even after the expense, you're going to be ahead on that fund. So it's the whole idea of penny wise, pound foolish. And I've used that saying a lot over the years. My CPA actually introduced me to that term probably 5 or 6 years ago. It's just stuck with me. So focus on making the big money. Don't focus on pinching the pennies. So like I said, don't ignore the fees of the plan, and don't ignore the expense ratios on these funds that you have. Be aware of them, but you've got to remind yourself, the way I am going to win in the game of retirement is by doing it. Do the things, contribute to your plan, do everything in your power to get up to the match. And then once you're there, systematically put in more and more until you are able, if you're able, to get up to the maximum every single year. And again, even if you don't max out, that does not mean you're not going to have a successful retirement. We have clients that have a couple $1 million in their retirement plan, and now it's rolled into an IRA with me because they've retired, et cetera. But they never maxed out their 401k. In some cases, they get to maybe 10% of their contribution based on their salary, and that 10% is not close to the maximum. But what I'm saying is, if they were able to have a couple $1 million in their retirement plan and they really didn't do anything crazy cute or sexy or selective with investments, or say, hey, I'm going to get this cheaper expense ratio and try to make money on the difference, it doesn't matter in the long run. So don't make the things that don't matter matter. Now, one thing that is really, it's not talked about, and it should be talked about more, is the over-reliance on company stock. So it is not uncommon for companies to, especially massive publicly traded companies, think of like the Microsofts or Googles or Amazon, whatever, to offer their own company stock within the retirement plan. On one side of the coin, it makes total sense to do so. And actually, I think it's a pretty prudent thing to do for all parties involved. If you go and invest in that and the company does better, you are going to do better because you are part owner in the company. That's what a stock is. It's a fraction of the business. On the flip side, the business wants to offer that to you because if you have it within your portfolio and you're working harder to grow the business and you're incentivized to do so, well, by definition, the owners and the executives are going to do better. Like, everyone wins. And there's also some cool little tax strategies with employer stock. And I'm not going to get into the weeds of it, but if you Google like net unrealized appreciation, you can actually take stock that is pre-tax and convert some of that into pre-tax. And then you can take all the gain and convert it to capital gains tax, which we've done for a number of clients that are executives or at like Microsoft or Google, companies of that nature. So if you have a lot of company stock in your retirement plan and you have questions on how to avoid a lot of potential tax liability, give us a call, because that is something that is highly, highly, highly sophisticated, but it's pretty cool. But beside the point, back to the task at hand. With an employer stock, the negative with that is some people get so concentrated in that business, and just because you work there and just because you understand it, that doesn't necessarily mean that you should continue to invest in the business that you work for. And I know that sounds really counterintuitive, but think of it this way. Sometimes you get in your own way and you get in your own blind spots, and you have confirmation bias, meaning you work there and all you do is surround yourself with people that are very pro whatever company you work for. And you're not looking at the other side of the coin to see, oh, what could possibly go wrong? So don't overly rely on the employer stock. I'm not against it. I'd actually say I'm not going to say that. I'm not against it and I'm not for it, but I'm also against it and for it all at the same time. You need to understand your company, not as an employee, but as a founder and as the business owner. So just be aware of that. Now, one thing I did want to say is you need to understand when you need to start adjusting your allocation towards retirement. Because even though we talked about before the break, Rob Arnault and the target date funds and flipping it and understanding that, the market should be the majority of your portfolio as opposed to what conventional wisdom says, eventually you need to start taking chips off of the table. Now, as far as when to do that, it gets really hard to state a blanket statement like that because obviously everyone's situation is different. But I'm going to do my best to give some blanket advice here with this. On average, you should be revving the engine as much as humanly possible until 3 to 5 years out. Okay. Now, the reason why I give that range is, let's say that you have a couple really good years of returns. And so your portfolio is actually ahead of schedule as far as when you need to retire. Well, then you could take those premature returns that were gifted to you early, and you could be a steward of those gains and allocate those to much more immediate retirement dollars so that you can now retire on your own terms, not your money's terms. But then if you don't have those gains and it's just, everyday conventional returns, 3 years, that's a really good range where you think, okay, should I start taking some of these gains off of the table? For sure, within 1 year, you need to get mission critical on knowing what you need to do to allocate your retirement plan. Because if you have, and actually this is a prime time for this, let's say that you retired at the early part of 2025, let's say in like the April timeframe. Well, the market is down rather substantially. Okay. And depending on, when you're looking, it could be down substantially or not. That's a whole nother conversation. But let's say that your portfolio is down 10% year to date. Well, if it is all within the market, you just got a 10% cut, and you probably don't want to allocate that money when it is at a loss. But if you got ahead of that in 2024 or 2023, and you were active with this and you took those chips off the table, would your market portion of your portfolio be down? Yeah. I mean, you can't avoid that. Okay. Like your planner in your investment prowess, like you're not God. Okay. You can't just like magically make all of these things come true. But if you allocated money, again, according to your framework, instead of being down 10%, I don't know, collectively maybe down 1 or 2. Okay. I'm not guaranteeing returns or any of that. I just making blanket statements here. And then your stock portion of your portfolio, you have more than enough time for that to recover. And then eventually, when that does have a nice little bounce back, whenever that is, that's when you can start taking those gains. And then you're toggling between money for today, money for tomorrow, versus just that conventional pie chart methodology that you see within your retirement plans. Now, as far as ongoing management in when and how to rebalance. So I mentioned some of this before the commercial break, and this is going to sound like I'm repeating things, but I'm really not. Within your retirement plans, now, first off, what does rebalancing even mean? Basically, let's say that you have, in theory, 80% of your portfolio within one fund, 10% within another, and then another 10% in another. Okay. So 80, 10, 10. And let's say that 80% portion of your portfolio just does really, really well. Well, from an allocation perspective, instead of being 80, 10, 10, it might be like 95, 2.5, and 2.5. So what rebalancing is you basically take those gains and in theory, lock those in and buy the other two minute strategies that you have that maybe haven't performed as well. Because maybe right around the corner, those positions do really, really well. You take the gain and you keep rebalancing. I mean, that's rebalancing 101. With retirement plans, you don't really have a choice as far as being what I would refer to as dynamic with your money. So it's going to be pretty fixed, meaning you can rebalance it on an annual basis, a quarterly basis, monthly basis, semi-annual. Occasionally, I've seen retirement plans where they actually rebalance daily. I think that's a little extreme personally, but my point is you got to work with what you've got. Frankly, I would say if you're going to have a choice between all of those, the more frequent you can rebalance, the better. But again, don't sweat the small stuff. I will say eventually when you get to a point, or if you get to a point where you can invest outside of a retirement plan, and especially when you get to retirement, you're not just rebalancing systematically like that. You need to be very dynamic and nimble in the mind when it comes to your money. But again, work with what you got. Okay. Now, the last thing I want to mention is your money within your retirement plan and investing within your retirement plan, rolling it over if you change employers. So when you leave a company, whether you retire or get fired, or you just go to another company, you have options with your 401k. And a lot of people think that, my 401k, I'm no longer working there, so suddenly I'm no longer invested. It's just sitting in cash. Not true. Not true at all. when you leave your company that you're working at, yeah, you're not contributing anymore to your retirement plan, but your investments, if you haven't changed them, are invested in the exact same portfolio. So, first off, from a rollover standpoint, what options do you have? One option is you could keep your investments at the company in which you left. And sometimes that's the best thing to do because maybe the fees are more, they're cheaper and more appropriate. Maybe the investments are more robust and you can invest more according to what you're trying to accomplish versus your new company, or if you've just retired. From a simplicity standpoint, there's a number of different options there. But the point is, option one, you could keep your money at your previous employer. The second option is you could take your money and roll it into your current company's retirement plan and then go through the same thing, get the investment options, invest according to what your new company or current employer has to offer. You could roll your money into an individual retirement account and then invest a little bit more custom according to what you're trying to do. And there's pros and cons with that. And then, of course, you could cash out your retirement plan, but do not do that because you'll have pre-penalties, you'll have ordinary income tax penalties, you'll have administrative costs with that. So if you took out $10,000 and you're under 59.5, which is the soonest you can take it without penalty, a few exceptions to that, but call it 59.5. And let's say you're in the 25% bracket, that 10 grand just turned into 6,500 like that. Not great. So you really want to make sure that you go over whatever options works best for you. And if you work with someone, if you work with a planner, talk to them about it and go over those options. And if you do this on your own, just make sure you weigh the pros and cons with things, but just know that when you leave that company, your money's just not sitting in cash. It is still actively invested. So that does it for today's episode on everything that you need to know regarding investing within your 401k. I tried really hard not to get too into the weeds because I could have really nerded out on this. And if you thought I did really nerd out on this, I apologize because it could get even worse. So, but all seriousness, I hope you enjoyed this episode. If you have any questions, you know where to find me at this point. As always, I'm your host, Christopher A. Panayiotou, certified financial planning professional, the Cap in Capitalize. And until next time, keep capitalizing. Take care. As always, thank you for joining me today. If you have questions about today's episode or any personal finance questions, please reach out to me at Cap and Capitalize on Instagram, Chris@capitalizeyourfinances.com, or via our website, capitalizepodcast.com. If you want more Capitalize Your Finances content, head on over to capitalizepodcast.com and check out our blog, free resources, book, and online course. As always, I'm your host, Christopher A. Panayiotou, certified financial planning professional, the Cap and Capitalize. And until next time, keep capitalizing.
The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. This material is gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed. These materials are provided for general information and educational purposes based upon publicly available information from sources believed to be reliable. The information in these materials may change at any time and without notice. There's no guarantee that any investment strategy will meet its stated objective. All investments involve risk, including potential loss of principal. All performance referenced is historical and is no guarantee of future results. You should always seek counsel of the appropriate advisor prior to making any investment decision. All investments are subject to risk, including the loss of principal. 401k benefits may be subject to change at your employer, the governing pension, or benefit organization's discretion. Your investment options are limited with a Roth 401k to those offered by the plan administrator. Charges and fees may be incurred. IRA withdrawals will be taxed at ordinary income rates. Withdrawals prior to age 59.5 may also be subject to a 10% penalty tax. This material should not be considered a solicitation of an offer to sell or buy any specific security or offering. Investors should consult a financial professional to determine whether risks associated with an investment in the shares are compatible with their investment objectives. An asset allocation strategy does not ensure a profit or protect against loss. Diversification strategies do not ensure a profit and cannot protect against losses in a declining market. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed and subject to potential federal and state law amendments. There's no guarantee that you will achieve the results discussed or illustrated. Stock investing includes risks, including fluctuating prices and loss of principal. CDs are FDIC insured up to $250,000 per deposit or per insured bank for each account ownership category. Before investing, carefully consider the mutual funds, target date funds, index funds, and or the money market funds investment objectives, risks, charges, and expenses. To obtain a prospectus or summary prospectus which contains this and other information, call your financial advisor. Read the prospectus carefully before investing. It is important to keep in mind that investments in fixed income products are subject to liquidity, interest rate, financial inflation risks, and special tax liabilities. Christopher Panayiotou is a registered representative with and securities and advisory services offered through LPL Financial, a registered investment advisor, member FINRA SIPC. Capitalize Your Finances LLC is a separate entity from LPL Financial. Capitalize Your Finances is not registered as a broker-dealer or investment advisor. CRPS conferred by College for Financial Planning. The people and companies mentioned in this podcast are not affiliated with or endorsed by LPL Financial or Capitalize Your Finances.